Hi, welcome to Thornton Singapore's Budget 2022 and Beyond webinar today. Thank you for joining us. I am Michelle, your MC for today. The slides and the recording of the webinar will be disseminated after the webinar today. There will be a Q&A session at the end of this webinar. Please ask a new question or you can upvote existing questions. There will be links or extra info given in the chat box, and there will be some polling for icebreaker that will automatically appear on your screen. But if you don't see the poll at any time, you can always click polling. There will also be a certificate of attendance for today's webinar. So if you wish to receive a certificate of attendance for this webinar, please make sure that you attend the entire webinar and complete the survey at the end of the session. We will email the certificate to you within the week. I would like to introduce you to David Sanderson, who is the Head of Tax and Singapore Practice Leader here at Thornton, Singapore. He joined the firm in July 2019 to head up the tax practice after a 35-year career in international tax with a Big Four accounting firm in London, Melbourne, and Singapore, as well as a 5-year post-retirement spell running at his own practice. His unique international experience helped his multinational clients, both big and small, structure and manage their cross-border business operations, not only from a tax perspective, but also from a commercial and practical perspective. Let's welcome David to give us a quick introduction. David, please.
Yes, good afternoon, everyone. And thank you, Michelle, for that extensive introduction. I think it's actually 40 years of doing tax, if I remember correctly, or can remember that far back. I'm not intending to give such an illustrious introduction to my colleagues this afternoon, because you'll get a good chance to meet them later on when we have our panel discussion session. But here to join me today is Eng Min, first of all, who looks after our corporate tax practice. She's involved in both international and domestic tax advisory, tax compliance. As you can see from the photograph, hasn't been around quite as long as me, but does have extremely extensive experience, both in the profession and outside, and also in academia. So Eng Min will be joining us today. Also, as part of the panel, we have Adrian Sham. Adrian has been with the firm some 14 years now, Adrian. Based originally in London, but coming out to Singapore a handful of years ago, effectively to be one of the early starters of the new Grant Thornton firm in Singapore. He's in charge of employment solutions and our private clients, and he'll be having stuff to say later on today about some of the so-called wealth tax changes that we might have seen. And then last but not least, we have the very young and spruce looking Jeremy O'Neill. Jeremy also started his professional life in the UK and came out to Singapore some 3 years ago. He is our GST guru, and of course GST was quite central to what happened in the budget on Friday, and we'll be hearing from him later on. So our agenda today, with this star-studded lineup, is one of the things that we usually do, is we pick up where we left off last year and join some of the dots to take us up to the doorstep of budget 2022. So we'll have a quick run through and a refresher of some of the things that happened last year that you may or may not remember. We're then going to have highlights of budget 2022, i.e. picking out the important pieces that people might be interested in, certainly from a business perspective. That is going to be presented by Eng Min. So she has bravely stepped up to the plate to handle both of those, looking backwards, looking to last Friday, and then the panel session will kick in with also Jeremy and Adrian to look into our crystal ball and see what the budget may hold in store for us going forward. At the end, as Michelle said, we will have a Q&A session, so keep typing your questions in as they occur to you as you go. As she also mentioned, there's a little sort of thumbs up thing you can press, which gives us an indication of what are the most popular questions, because we inevitably find we don't get through everybody's questions. And so if we can start with the ones that people think are the most important, then that helps everybody out. So I think on that note, I will hand over to Eng Min, who will take you backwards and forwards.
Thank you, David. Hello, everyone. I will take you back first. And what I've done is that I've picked some changes which I believe is interesting for you to know. And I'll start with the first one. Just give me a sec. Net. Oh, okay, right. Okay. Okay, the first one that I'd like to discuss is really tax residency of a company. Now, in Singapore, how do you determine whether a company is tax resident in Singapore? You look at where the control and management of the company is. So what does control and management entail? You then look at where the board of directors actually hold a meeting. Is some principles that has been, that we actually have gleaned from some tax cases. So you look at where the board of directors hold the meeting. If it's held in Singapore, then we say the control and management of a company is in Singapore, and hence the company will be considered a tax resident company of Singapore. Now, because of COVID-19 and the travel restrictions, a number of companies cannot hold board meetings in Singapore in FY 2020 and FY 2021. So what the Singapore Revenue, what IRAS has done is that IRAS has actually introduced this concession to basically say that, okay, no BOD meeting in Singapore, fine. We just want to make sure that you have been a tax resident before, and then there haven't been any changes in the circumstances of a company, and then you do have meetings as held outside Singapore via electronic means. Now for these sort of companies, for YA 2021 and 2022 as a concession, the IRAS is actually prepared to grant you the certificate of residence. IRAS is prepared to treat you as a tax resident company of Singapore. And some of you may know that this is important for you if you want to get any treaty relief under the many double taxation agreements that Singapore has entered into with different treaty partners. Now, the purpose of bringing this up for discussion is really to ask you to think about post-COVID-19 era. What is going to happen? What's the relevance of physical meetings? Now, COVID-19 has definitely or significantly changed the way businesses operate. A lot of companies has adopted technological solutions, and even for meetings, very often is via video conferencing and not physical meeting. So if this sort of trend continue into the post-COVID-19 world, what's going to happen? How would the Singapore Revenue look at the tax residency of the company? So because of this constraint, and also because in the brave new world that we're going to be in, there may be less physical meeting. SCTP, the tax professional body, has actually brought this up with IRAS to ask IRAS to review this. Now, the good news is IRAS is prepared to look at this physical meeting condition as to whether it should still be there. And IRAS has also communicated that in essence, what is more important is the substance of whether the control and management of the company is really exercised in Singapore. Now, up to this point in time, we're still looking at where the board of directors meeting would be held, but this is something that IRAS would actually look at, and perhaps some changes may be forthcoming in the future. And I believe more guidance will be introduced, will be released by the IRAS in the near future on this point. Now, the next update that I wanted to share with you is pertaining to the deduction of expense. Now, this is on the deduction of expense relating to lease of immovable property. Now, in the past, what happened is you incur this sort of expense, and because the Singapore tax legislation doesn't allow a deduction, so to speak, the Singapore Revenue actually said that you can't take a deduction. And then there was some sort of like discussion with SCTP. And at that time, what the revenue say is, okay, if you put through this claim, and if after reviewing the case law, reviewing the tax law, we find that this claim is wrong, we will not penalize you for the claim. Now, the good news here is this is over. What I've just said are all history. Now, from this point onwards, you can claim any of these commissions, legal fees, or stamp duties that you paid to secure the tenancy of your office premise. And as long as the lease period is 3 years or less, you can take a deduction on these expenses. And if you are a landlord, then you can take a deduction of these expenses against your rental income. So this is a good move. At least there's some certainty on the deduction of this sort of expenses. Right? Okay. Now, the next one that I would like to talk to you about is the foreign tax credit claim. Now, first of all, let me just explain what's foreign tax credit claim in Singapore. So basically, the foreign tax credit claim is in respect of income where a foreign country has a right to tax under the relevant treaties between Singapore and that country. And then, because the treaty is to eliminate double taxation of the income, the same amount of income may have been taxed overseas, and then it'll be taxed in Singapore, and therefore Singapore will grant you the credit. Now, but the credit to be granted is the lower of Singapore effective tax rate or the foreign tax suffered. So most time you get the Singapore effective tax rate because our Singapore tax rate is relatively lower compared to countries in the region. So most time you get the lower of the two, which is basically the Singapore effective tax rate that you suffered on this foreign source income. All right, but then there are other times where, let's say, after you do a claim for your foreign tax credit, and then maybe there's some appeal that you may have made overseas. As a result, there is a downward adjustment on the foreign tax suffered, meaning to say it has been reduced downward. And if that is the case, the requirement here is if there's a downward adjustment, and if the downward adjustment make your original FTC claim excessive, you are then required to notify the IRAS within the 1 year from the date which the adjustment is made, right? So you are basically to give back to IRAS. So this will only happen if, I said lower of Singapore effective tax rate and the foreign tax. This will only happen if your foreign tax suffer is lower than the Singapore effective tax rate. And therefore, if there's a downward adjustment, you need to go back to the revenue and give it back to them, the excess that you have claimed. And also in the past, for FTC claim, you're supposed to meet it within 2 years. Now this time limit has been decreased to 4. Okay. Now the next change that I think I will need to highlight to you is actually quite critical. Because in the past, if you have a scheme, you enter into a scheme which is considered a tax avoidance scheme, then basically what IRAS would do is to just merely counteract all the advantages that you have obtained. So let's say you get some additional deductions or whatever, they will just remove it, full stop, that's it. Now what is a tax avoidance scheme? Usually it is one that's artificial, contrived, or has little or no commercial substance, and is designed to obtain a tax advantage that's not intended by the parliament. So if the Income Tax Act say you can do a double deduction of a certain expense, and when you do that, that's fine. It's not a scheme. All right, but if you purposely put in something without any bona fide commercial reason so that you can have some tax savings, now in the past, no skin off your nose. Basically, you're put back to the original position, and then maybe you just pay whatever additional tax that you need to pay on that basis. But going forward, in fact, effective FY 2022, basis period FY 2022, effective YA 2023, if there is any scheme that's considered a tax avoidance scheme, then IRAS is empowered under Section 33A of the Singapore Income Tax Act to impose a 50% surcharge on the additional tax that they could have imposed in the absence of this tax avoidance scheme. So I think then it becomes very critical for you to basically relook at some of your existing structure or scheme to see whether you are in danger of violating the rules, and it is in danger of being considered or being called a tax avoidance scheme, right? Oh, okay. The next one that I'd like to talk about is this bit about trading stock appropriated for capital purposes. Now, if you are in a business that you say manufacture some parts or some machines or whatever, and these machines could be sold or it could be used by your business. So when it's used by your business, you appropriate it. So basically you move it from your trading stock to the capital, your capital assets, and then for capital allowances purposes. Now, if you do that, once there's a change in intention and there's a reclassification of the use of the stock, although the income has not come home to you because you have not sold it to anybody outside of your company, it's still used by you with effect from 16 November of 2021. If there is a difference between the open market value of this item and your cost of production, cost of purchase, that difference become a taxable event. If it is a profit, you'll be subject to tax. If it's a loss, you can get a deduction. So the key here is that don't think that I have not sold the stocks and therefore I am safe. I just reclass from trading stock to capital asset and therefore I'm fine. No, that's not the situation now with this new enactment of Section 10J. You will need to look at the item in questions and see whether it will result in a taxable event for the company, right? Okay. Now I'll move on to the highlights of the budget for 2022. Now, before I looked at it, before I looked at it, I would just like to express my view of what I think this budget 2022 is. From my angle, it looks rather bland from the tax front. There's no new policies. No new policies have been introduced. There's some tweaking of the existing schemes, some announcement of increase in tax rates, which you all know by now, other than corporate tax. But apart from that, nothing really earth-shattering. Okay, so let me start with corporate tax. Now for corporate tax, I have the opportunity to use the same slide that I did last year, that basically say no change, no change, no change. So no change in the corporate tax rate, still the same. No change in the partial tax exemption. No corporate tax rebate granted. So it's business as usual as far as corporate tax rate is concerned. And then for GST, I think we all know before the budget that it will go up, it will increase. What we don't know is whether it's going to be a two-step increase, 1%, 1%, or is it going to be a when the increase will be put in place. Now, if you look at the chart now, it has been going up, our GST rate, but at 9%, we're still quite low internationally. And I don't know when it will become a double-digit rate. So, at least we now know for a fact that it's going to be 8% next year, January 2023. So you can do all your purchase this year. You can do your own planning. And then the following 1% will be January 2024. Okay, now when it comes to personal tax, I think for the very high income earner, other than having to pay more GST next year, they will have also to pay more tax on their income. So the bracket, two new bracket has been introduced, the 23% and the 24% bracket. And this is on income between 500,000 to 1 million. And anything above 1 million is 24%. So the gap between the corporate tax rate of 17% with all the partial tax exemption and the 24% is actually wider now, much wider. And this will come in for YA 2024, which means to say all the income that's earned in FY 2023 will be covered under this new tax band. Okay, I'll just move on to property tax. Now for property tax, if you have owner-occupied property, means the property that you buy and then you stay yourself. Now, if your AV is less than 30,000, you are fine. There's no increase. But if your AV is more than 30,000, then yes, from 2023 onwards, there's an increase in your, in your property tax rate. And if you are one of the fortunate people in Singapore who has a property which is non-owner occupied, which maybe you keep it for rent or for investment or whatever, for this category of people, for your property, if on the first 30,000 of AV, you need to pay a little bit more. There's like a 1% increase each year between 2023 to 2024. Now, if you own very nice luxurious property, then the property tax rate increase is much more. You can refer to our commentaries for all the details. I'll not bore you with all these details. Okay, and then similarly, there's this talk about carbon tax. So I thought for completeness, I would just include this. It's a $5 per ton now to $25 between 2024 and 2025, and then $45. Now, as to whether this would work in reducing carbon, footprint of people or not, I am not sure, but this is the tax that we're going to have. Okay, and then next, what I'm going to do is I'm going to cover a little bit of the GST changes, the zero rating changes that has been announced in the budget. So if you are providing travel arrangement services, do note that there's been a change. So whether you can zero rate or not, it really depends on the customer belonging status, and no longer depends on the use and enjoyment of that underlying services. So you go back and look at who is your customer. Does your customer have a business establishment or a fixed establishment in Singapore? Does your customer belong here in Singapore? Or if your customer is GST registered, to decide whether you can zero rate. So if your customer is GST registered, then if you revert back to the default zero rating provision, you can zero rate it. But if your customer is not, then you may have to put a GST on this travel arrangement services that you're going to charge on your customer. Okay, and then the next one, this one on media sales were actually announced in December of 2021, not part of the budget, but it's similar to the zero rating change for certain kind of services. So I thought I'll put it here. Now, if you're a local GST supplier, registered supplier, with effect from 1st Jan 2022, you no longer look at whether the advertisement is circulated overseas or in Singapore to decide whether you can zero rate it or standard rate it. You go back to the default zero rating provisions. You look at the customer's belonging status. You look at whether the beneficiary of the service is a GST registered person, and then you decide whether you can zero rate. And for completeness, I've also included, the other 2 points. Now, if you happen to be an exempt, you're a partially exempt person, meaning to say you cannot claim full GST on all the GST that you have incurred, then going forward, you need to do a reverse charge. It's where the advertisement is placed is not relevant anymore. You'll have to do a reverse charge on this media sales that you're actually paying for. And if you are overseas online media supplier, if you're making a supply to a non-GST registered person, then it is within the scope of the OVR, the overseas vendor registration scope, right? So that's a bit about GST. I'll just now move on to the corporate tax changes. Like I said earlier on, nothing really much. I will focus on the first 2 bullet points, and the rest, I think you can see them in our commentaries. Details of the first 2 bullet points you can also see in a commentary. Now, the first one on the enhancement of the fund incentive. Now, for fund management incentive, there's this concept of specified income from designated investment. So if you have a specified income derived from designated investment, that specified income is exempt from tax here in Singapore. So currently, if you're trading in physical commodities, it will be considered part of your designated investment if you meet 2 conditions. Number 1, the physical commodities trading must be incidental to your derivative commodity. So there's this incidental sort of condition. And then the second condition is that the trade volume of such physical trading is kept at 15% of your total trade volume. So there are 2 conditions. There is the incidental condition, then there is the 15%, the volume cap. So with the enhancement to this incentive, 2 things has happened. First, the incidental condition has been dropped. So you don't need the physical trade to be incidental to the derivative commodities trade. That condition is removed. The second condition, which is the trading cap, unfortunately, this one has gone down instead of the 15%, it is now capped at 5%. So it's been revised downwards to 5%. Right. The second point that I'd like to talk about is the approved royalties incentive scheme. Currently, under this scheme, what happened is that the withholding tax payable on these approved royalties may either be exempt or it may be reduced, not the 10%, domestic tax rate, but it may be a lower number. And currently what happened is that you have to apply to EDB agreement by agreement. So you have this agreement, you go to the EDB and say, can you give me that, reduced rate? Yes or no? And then after that, you have another agreement, you have to go back again. So going forward, what EDB intend to do is to simplify it and have a cover class and cover a class of royalty agreements based on activity set-based approach. So they will look at the whole class and say that, okay, all payments under this set of agreements would be granted that either exemption from withholding tax or a reduced withholding tax. So that's the part that has been simplified. Okay, now I'll just move on to the next one, which is mentioned in the budget speech itself, together with Pillar 1, but only Pillar 2 feature in Annex C of the tax changes that has been introduced. Now, first of all, what is minimum effective tax rate? Now, to understand that, maybe we have to go through what it is first. Now, first, it doesn't cover all sorts of companies. It only covers multinational enterprises with consolidated revenue of euro 750 million. Now, there are about 1,008 such M&Es in Singapore. And what it basically says is that if the Singapore tax rate is less than 15%, say for discussion 5%, then there's a top-up tax of 10% that has to be paid in the parent company, at the parent company level in the home country. So this will actually make our incentive scheme look very wobbly and bad, because what's the point of having all this incentive here in Singapore only for you to be taxed on the top-up basis in your home country? So that's why we are actually looking at it. And what Minister of Finance has said is that we are studying the introduction of this. We're not saying that we're going to introduce it. We're going to study and see how we can actually introduce this minimum effective tax rate. Simplistically, it just means that, okay, if you're paying 5%, okay, fine, I'll tax you another 10. So you're 15. So, in a home country, you should not be taxed again. But of course, the details are definitely not out yet. It's still in a very preliminary stage, but I think it's good for, for you to know about this. Okay, the next one is on administrative. The next slide is on some administrative changes that the IRAS has, I guess maybe at the request of the various government agencies, this has been introduced. Now, when I first read this, this is under existing section 612. I was like, you need consent of taxpayers. So if IRAS come to you and said, can you give me consent to disclose this information? I'm not sure whether you will really say no, or you will basically consult your lawyer before you say no. But basically, there are two sets of rules here. With the consent of the taxpayer, IRAS can disclose certain items. Without, IRAS can only disclose it based on whatever that's specified in the legislation. Like the Department of Statistics can get certain kind of information to be disclosed by them. Okay, so what the proposal basically say now, we will come out with a list of identifiable information. This can be disclosed without the consent of the taxpayers to the various agency. It could be an EDB asking for it. It could be an MAS asking for it. It could be anybody or CPF board asking for it. So the only promise here that we have is that the information that will be disclosed will be less granular to protect the confidentiality of the taxpayer. So it would be like given in a band, people in this, this category, and it will not allow the user of the information to basically to be able to nail down and find out who this person is. This is really for data sharing, for them to do analysis, to review policy decisions, to see whether they should be introducing new policies or whether the policies that have been introduced is working. Right. And then the last slide, I've actually put in some very non-tax sort of issues. I mean, announcement that has been put, a non-tax announcement that has been made during the budget. And you can see that it is basically, you know, for all the employment passes, S-pass requirement, increasingly it'll be more difficult, or rather it's more difficult because the minimum qualifying salary band has increased, will increase over the next few years. So in terms of the immigration considerations, this would hopefully mean that more locals will be employed in some of these industries, or rather make employer consider and look at local employees, you know, when they have positions available. But maybe the issue is more they can't find local qualified employees, but that is a separate discussion. And then of course, the last one is on the Erf fee for luxury cars. This one is really us going in the direction, Singapore going in the direction of wealth taxes. If you can afford to buy a car, buy such a luxury car, maybe that rate of 220% does not really mean much to you. So it's really more Singapore going in the directions of taxing the have more than the have-nots, and then making the system a bit more progressive rather going forward. Okay, right. I've come to the end of my update. I will pass the mic over to David, and David will do a poll before we start the panel discussion. Yeah, David, over to you.
Lovely. Thank you, Eng-Ming, for that concise gallop through the what's happened last year and this year. So just a little poll to get our discussion going, because obviously it's an open discussion and we'll go the way that, that everyone wants to go. But the question is, which aspect do you think will impact yours or your business the most out of what came out of the budget on Friday? Number one, the GST increase. Number two, minimum effective tax rate and BEPS Pillar 2. Wealth-related taxes on property, luxury cars. Increase in the personal income tax rate. The increase in the minimum qualifying salary for employment pass and S-pass holders. And then, actually, Eng-Ming, did we mentioned the carbon tax, did we? As you were going through that?
Yes, we did.
Sorry, I must have been trying to answer somebody's question.
We did.
Or the carbon.
I didn't give a lot of details. I basically say it is there.
No, good, okay. Or the carbon tax. So you can click one and one only. It won't let you click them all. So why not have a go at clicking and submitting? What's affected either you or your business the most, do you think, or will do? Oh. Okay. So Nat, is that the end of the survey? No more coming in?
On behalf of Nat, yes.
On behalf of Nat. Right, thank you, Adrian. Right, well, the GST increase has it. Now, of course, behind that, the answer there must mean it impacts your personal situation rather than necessarily your business situation, unless, of course, you happen to be a small business underneath the registration threshold, because bigger businesses can obviously can recover the GST and pass it on down the chain, whereas as an individual, you will meet it in the shops, in the restaurants. As a non-registered business, it's a cost that you will have to swallow or somehow pass on to your customers. So it's interesting that the GST increase, which we're all sort of anticipating in different forms, has come out the top, and then really the rest are a long way behind. Minimum effective tax rate, yeah, understandable, because that's still a way down the track. wealth-related taxes, obviously everyone takes the bus here by the looks of things. Increase in personal income tax, same thing you could say. Increase in minimum qualifying salary for EP and S-Pass. Well, of course, that also depends on the industry sector you're in. Possibly the S-Pass will have more impact than certain areas where employment passes are given out, because employment pass holders maybe are already earning above the minimum there. And then nobody really seems worried about carbon tax. So interesting. So on that note, Jeremy, you have center stage, because everyone was waiting for the much denounced timing of the increase. I have to say that we in GT thought that it might come in one go, just to get it over with, bite the bullet, 1st of July, particularly as we got some other GST changes coming up on the 1st of July 2023. What's your take on it, and why do you think the government went the way they did?
Thank you, David. Yep, like you said, I think most of us were expecting it to be a one single hike, 2% at the same time, and to happen sooner rather than later. A few experts have done a calculation on the back of a piece of paper, and they've actually worked out the way the government is implementing the rate hike when compared to doing a 2% rise in the 1st of July is going to cost the revenue about 1.5 billion. So but by delaying it and also staggering it is actually got quite a big cost to the tax collection. So whilst that is obviously a positive thing from a consumer's perspective, and may help to bolster consumer spending, it's obviously something that is not as favourable to the business perspective. Obviously, when we have two changes in GST rates, we have to consider the transitional provisions, making various changes, and one-off costs become attached to making the changes, whether that's going through and updating our finance and our billing processes to account for that, going through reviewing contracts to make sure that all these price increases can be captured, and then also the display of requirements as well. So to me, speaking from a consumer perspective, I'm obviously quite happy that that stagger has been delayed, but obviously sitting with my professional hat on and thinking about it from a business perspective, I'm not quite so happy about it, especially with all the additional changes, as you say, with the low value goods and the extension to the overseas vendor regime, which is going to capture remote services from the 1st of January 2023. Obviously, Q3, Q4 this year are going to be extremely busy in terms of helping clients get ready for that date. So that's just a few things for people to think about there as well. You're on mute, David, I think.
Somebody put me on mute while I wasn't looking. I didn't do it on purpose. The transitional provisions, are they, I mean, just a question, are they not routine sorts of things? I mean, when you've done it once, can you not just say, well, I've done that once, I just need to repeat that, 1 January 2024, or does it need a lot of specific thought and planning each time you do it?
So you're correct in the sense that generally when there is a rate change, which, as we saw from the timeline, has happened a fair few times over the last 20 years or so, the basis for the transitional provisions are generally the same. I guess the point is, in practice, they'd still have to go through and review the contracts for the specific contracts that do span that date change. So it's not necessarily something that is new from a technical perspective, but they still need to consider at the point where they do have contracts that span, they still have to go through that process to determine whether the contract would be applicable to the 7% or the 8% or even the 9% when it comes in, or whether actually if you have various billing points, whether you could have a contract which could be subject to 7% and 8%, depending how far through the contract you are.
So could a single contract be subject to 7%, 8%, and 9%, or are there mechanisms that prevent that? Because if you've got a contract that lasts more than a year, it could kick off in 2022 and finish in middle of 2024,
Yep.
or wherever else. So is that an issue as well for those costs, uplift in costs now being baked in to existing contracts?
It is something that definitely could happen from a theoretical perspective, and is probably going to happen from a practical perspective. For example, if you had long-term sort of construction or engineering projects, which, as you say, can span a number of years, that is something that businesses will have to consider and look at the GST clauses within their contracts to ascertain whether, for example, if you had a contract that was written that all the contract prices are subject to GST at the prevailing rate, then you wouldn't necessarily need to enter a new contract from a pricing perspective each time there is a change. So I guess these are the sorts of things that businesses should begin to think about and review those contracts which are potentially going to span the change, the high rate in January 23 and January 24.
Okay, and so crystal ball. Engmin showed a very nice diagram of an upward trend in GST, potentially going off the chart. We're at 9% in 2024. I think the UK is 20%, certain European countries 25%. Are we ever going to get there?
Yeah, well, just looking at it, I guess, from a European perspective, which was originally where I trained, you've got VAT rates ranging from 15 to 27%. But I guess that is just looking at it from a headline number perspective. What we also need to consider is what's the tax base that is subject to GST or VAT in the first place. When you compare sort of the Singapore GST tax base to a European VAT tax base, we have a much wider, broad-based form of taxation here in Singapore. Just a couple of examples, things like your medical and your education are subject to GST here in Singapore, whereas from a European perspective, those are not they're not liable to VAT. And that kind of shows when you look at GST and VAT as a percentage of the overall tax collected. So I was just actually having a quick look, and I noticed that from a Singapore perspective, GST is about 21% of the overall tax revenues that were collected last year. And that was based on the GST rate of 7%. Now, in the same year, from a UK perspective, where the VAT rate was 20%, VAT was only just over 16% of the overall tax revenue. So actually, the headline percentage can be misleading from that perspective.
Yeah, sure.
You need to look at it in conjunction with the broad basis of the tax at the same time.
Yeah, and I suppose the fact that the UK also imposes 45% top rate of personal tax, which is going to dwarf quite a lot of stuff. But it's a good point. The question is, do we have a sneakily high effective GST rate? Be something I might ask. But anyway, we'll leave you alone for the minute, and maybe Adrian, and it's one of the points that Min touched upon in her chat just now, the discrepancy between the corporate tax rate of 17%, which actually never gets to 17% because of the partial exemptions, and the new super rate of 24%. That's a 7% discretionary, whatever the word was, between the two. Is that going to put pressure on people setting up their own personal services companies, on tax planning around that? Where is that going to head? And the other subsidiary question in that, maybe for you, Min, is that part of this is created by our one-tier tax system, because you only get taxed once in Singapore. So once you pay tax 17%, see you later. Your dividends are exempt. You don't pay the top up as you do in other jurisdictions. So, Adrian, what are your thoughts around that?
Just touching on GST first, since it's such a hot topic, even for individuals.
Okay.
Given that I'm buying a lot of baby stuff at the moment and property-related stuff, moving furniture and stuff like that, I can certainly say that there's a lot of GST for individuals as well. But moving on to the question that you raised, when we see a larger difference between the corporate tax rate and the individual tax rate, and exacerbated here with the lack of a dividend tax because of the one-tier taxation system, the incorporation and setting up a personal service company does start to look even more attractive for those on the top rate bands who can create their personal service companies and provide consultancy services to their previous employer, so to speak. So we've already had some questions earlier today about that, actually, David. So I would be surprised if we saw more of those questions in the future. And I guess the increasing of these rates came as a little bit of a surprise to us. We expected them to target individuals and corporates, given the government's announcement that there's not going to be enough tax collected through GST. Where else are they going to collect it? But it seemed to me a bit of a take type of budget, especially from my side of the fence. You know, you've raised individual income tax rates, you've raised a number of taxes related to wealth, but the government's not done anything to try to attract those business decision makers to Singapore, which is something that we included in our wish list. Because if you bring those individuals to Singapore, obviously they'll pay more tax, or they'll pay tax because they've come to Singapore, but you'll have the knock-on effect of them paying more GST, maybe them employing people. So yeah, there's a number of things that we saw and we expected in the budget, but maybe it didn't go far enough in my view.
Yeah, I wonder. I almost get the impression that the increase in the top rates there were just a bit of a sort of last-minute rush, a bit of a clutch at straw. Because to be honest, I only thought about it at the end, and I think we got quoted somewhere saying, "Oh, they might they might put a new rate in for over 1 million and another one for over 500,000, and then 3 days later it sort of pops up. I don't know, was it a rush job?
David, the secret advisor to the government. Well, certainly the focus was more on wealth taxes in all the media and the government reaching out. There wasn't a huge amount discussed around increasing individual taxes. I think in our wish list, we did talk about increasing marginal taxes for the wealthier, but through a different mechanism than necessarily increasing the top rates of tax. One thing that I guess employers will need to consider is that if you have people who you tax equalize or expats you're moving, then this could be an additional cost to the business, maybe one for your HQ to consider. And those with employees with, you know, large equity type awards, which could push an individual into higher tax rates, especially when they exercise or they vest, or even when they deemed exercise or deemed vest, then this could be quite a significant impact on those individuals and those businesses. So attracting those top talent and retaining them may have an additional challenge, so to say.
Sure. And in fact, just on a slightly different note, but around that, I think one of the Q&As have already come up, which I inadvertently tried to answer live, but obviously pressed the wrong button. So let's answer it now. The top rate of income tax in Singapore is the one that is applied to non-resident individuals. So we would be seeing withholding tax on payments to directors, this thing around arbitration and mediation, etc., etc. Their appropriate rate of tax for the net basis would also be 24%. Is that right?
Yeah, so 24% is the top rate, and that will be applied to most non-resident rates, as you said, directors, you know, rental income from non-residents, and that applies for income starting 1st of January 2023, so YA 2024. For arbitration and mediation, because obviously Singapore is trying to become a hub for mediation arbitrators, I think there is a reduced rate for them, extended for a number of years.
Yeah, you can do 24 on the net or 10% on the gross.
Yeah,
I believe is the thing. But Eng Min, so coming back to you after you've had a little breather, going back to the corporate tax rate, because as I mentioned earlier, and as you mentioned, the discrepancy between 17 and 24 is quite chunky now. It's not the sort of amount, it's not the sort of money you'd want to give away if you can do it. Do you think the government could be thinking of it the other way around, that the personal tax rate will go up first, and then next year we'll follow it by a corporate tax rate hike, which catches up on that? And, you know, a rising tide floats all boats sort of thing. What do you think about that?
The first one on the corporate tax bit, I started, when I first started working years ago, I remember it was 40%. And it has been
42.
Okay, so I mean, I start 1 year later than 42.
Maybe I started earlier.
Yeah, I started a bit earlier. So it was, I can't remember, 40 or 34%. It has been going down all this year until we're at 17. I honestly, I mean, I don't think, you know, we would want to increase our corporate tax rate, because it's one of the, I think it's one of the, you know, attractive features of the Singapore system for people to come here and set up shop, set up business and all. So the corporate tax rate bit, I think my personal view is that it won't go up. But on your question about the variation between, you know, between the 24% and the 17%, I remember earlier on when we first have this issue, we looked at the point of, why do people set up company? Why do I need to set up a company? I set up company because I need the separate legal protection. I need to protect my assets. So that's why I put it into a company, right? So because maybe my business has grown to, you know, to a certain extent, and therefore I need to protect my other assets from, you know, from the running of the business. So I set up a company and I put my business there. And then you knock on my door and say, hey, I think you're doing some tax planning, because, you know, if you set up a company, you pay tax at 17%, then you pay dividend is one tier tax exempt, and then you take the dividend back, and you don't have to pay that incremental 25% to 24 or to 22 or whatever. So I think the purpose of this increase is a little bit of like trying to tax the people who have it, the people who are super rich. They reach that pinnacle of 500,000, 1 million per year. And to them, what is that 1% or 2% differential? I don't think it's a lot if you are in that category. So, but of course, I see your point that if I want to plan, well, there is a difference. So I would say that you must have good commercial reasons to plan. Nothing should stop you from setting up a company just because someone is going to knock on the door and say that, hey, too smelly. I think you're trying to benefit from the lower tax rate.
Yeah, I would agree with that. And yes, of course, there's Singapore's developed a whole range of business structures that actually you should be able to choose from. They can't tell you, no, you can't use that one. But that brings us to the case about the dentist, right?
Yeah, but clearly,
who was done for using a company in a situation, but that I think was clearly where you had a fixed stream of income that was taxed at the higher marginal rates, and he just artificially broke it down into different companies. I agree, if you're carrying on a business where you don't know what the income is going to be, you've got assets you want to protect, etc., I don't think they can touch you. But I suppose the question then is that are people going to be starting to pile into companies?
I suppose, because of the differential, I mean, it's attractive. If you can save that whatever percentage difference, you would want to try and do it. But I think back to the dentist case, that one I think is a bit blatant. I think most of these service company, they are like in the same location, owned by the same people, and each one of them will enjoy the partial tax exemption, the corporate tax rebates in those days when you have them. So clearly, they were like cutting up artificially income into different companies. But if you have a good commercial reasons to set up a company, I think the anti-avoidance provision should not kick in. But to your other question about what is going to happen to our one-tier corporate tax system, that is something that we may think about it, because one-tier corporate tax system means at the corporate level, you earn the income tax, pay your tax once, that's it, finish, no more. So when you pay dividends to your shareholders, they take it home tax-free, no more dividends, no more tax on the dividend. If the concern is that people are manipulating, then maybe we can consider imposing some tax on this category of people.
What, you mean going back to the imputation system?
No, not the imputation, just impose additional tax on them, if I, may suggest.
The classical system then?
Yeah, the classical system, but not, so is the...
Wow, this is going back even before my time. Right? I started with imputation.
You started imputation, yeah. Okay, me too.
Yeah, okay. But do you not think in the context of the BEPS initiative where they're, excuse me, they're saying, for our tax incentives, there's probably a lot of carve-outs because they are built around substance and people, having to be here in order to get and meet certain targets in order to get the incentives. Isn't the point, though, that it's the effective tax rate that is important in looking at the 15%? And what we seem to be hearing is that there are 1,800 MNCs that fit into the 750 million euro category that would be caught irrespective of whether they've got incentives or not, because their effective rate, for various other reasons like other allowances, R&D,
enhanced deduction,
deductions, double this, double that, happens to be lower than 15%. Now, isn't the answer to that to put your 17% up to 22%, which means that, again, floating all boats, your effective rate goes up to the 15 and some of that disappears? I don't know, I'm just throwing that out as a thought. I wouldn't put it beyond reasonable doubt that we may see some tweaks up in just our basic corporate tax going forward, but that's just my...
Okay,
little personal view. So Adrian, we haven't talked about, I don't think, the wealth taxy bits, the stuff we're looking at. We saw it a long time ago that the easy way to raise tax was real estate, right? You can't hide it under your bed, you can't put it in your suitcase. What did you think about the budget response to that?
Yeah, so wealth taxes was obviously discussed a lot, and we early on said that a net wealth tax wouldn't work, a net annual wealth tax wouldn't work because obvious reasons. It's difficult to collect, it's taxing on illiquid assets, and a lot of countries have realized that and moved away from it. And we early on predicted or suggested that some sort of form of property tax should be implemented, which clearly the government has partially listened to and has implemented additional property taxes for residential owner and non-owner occupied properties. I guess, although we anticipated this, we think they could have gone a bit further. Property is a very sensitive topic in Singapore, with high property prices, both for buying and also renting. A lot of Singaporeans are having a challenge of trying to get onto the property market. And at the same time, we see a lot of foreigners taking up a lot of empty properties and not necessarily using them. So there's a lot of unutilized property out there. We had suggested a couple of things. One is to maybe get some of those unutilized properties used and have deemed rent on those unused properties, which would obviously potentially increase supply of properties in the market, reduce maybe some of the costs, and make it a bit more productive, but we didn't see that. The other thing that they could consider maybe in the future is a capital gains tax on some of these second properties. I guess these two ideas may not have come around because they were focusing more on property changes which were based on existing taxes, because obviously existing taxes are easier to collect. You're just fiddling around with the tax rate rather than putting new forms, new taxes in place, new collection methods, new monitoring, for example. So I'm not convinced that this is the last that we see on taxes for wealth. Given Jeremy's earlier comments of, delaying and staggering GST, leaving this almost black hole of monies that maybe the government was expecting, which they're not going to expect now. How are they going to plug that gap? Will minimum tax on corporates fill that gap, or will additional wealth taxes fill that gap? So I think this is the start. We've obviously seen some on luxury cars, and we've seen some on property, but maybe not the end of the road for that.
Yeah, possibly not. I agree. I don't think that's going to end. So one that that maybe you can all chime into, and that we haven't talked about, and that I have to admit none of us probably specialize in, is carbon taxes. So Jeremy, what was your semi layman's reaction to carbon taxes?
There was obviously there was a fair amount of talk prior to the budget around how to create a greener economy, how to increase the sustainability of the country going forward, how to leave a country for future generations, and that followed on from all the COP26 meetings towards the back end of last year. So it's not surprising that they're already making slight tweaks to carbon tax, which was only recently implemented. As we say, it's often a lot easier to make a few tweaks around the edges of an existing tax system, then create a whole new one, whether it was plastic tax or whatever it might have been. And I guess one of the good things about carbon tax as well is the way it's been implemented and structured. there's only a small finite amount of taxpayers that have to that will need to compute the carbon tax that is payable. But obviously, we as consumers will feel the cost of the carbon tax that they are paying. They will obviously be passing on that cost through the electricity and utility bills. So it is a tax that is being paid by all of the population, but from an administrative and from a tax collector perspective, there's only a very small number of taxpayers that the IRS have to manage in the first place. So it's quite an efficient collection model.
Yeah, because
from that perspective.
yeah, because there's only so many big players that creep into the market. But interesting at a time when we are staring high energy costs and inflation in the face, that we end up with something that could be increasing energy costs and therefore feeding through into inflation. So we'll need to see how that works out. Of course, the interesting thing is this is supposed to change behavior by imposing a penalty, but then even changing your behavior isn't free. If you have to introduce new technologies, you've got to spend a shed load of money investing in those new technologies, in R&D, et cetera. That is also going to be passed on to the consumer at the end of the day. So it is an interesting one, I thought. But anyway, we'll see how it plays out when we get our next electricity bill.
And just to add to that, there's always a long lead time with these sorts of technologies as well. So it's interesting to see that they've got this roadmap of, carbon tax is increasing quite significantly. I think they're almost quadrupling, if I remember correctly, by 2030. So, the large companies that are being affected by this do have some time till they get the top rates, unless they increase even further. But even to change is going to take, as you say, a lot of R&D and a lot of time. So even if they are able to, find some renewable versions which is cheaper, the consumer's not going to see that anytime soon. And you've got the added kicker of, additional GST on these energy rates as well. So yeah.
Yes, and
adding them up.
Indeed. So one could equate it to smoking, could we?
In what sense?
Well, the duties are there not necessarily to enhance revenues, but to stop you smoking.
Or it's hard to get.
It doesn't seem to work, but it's great. But it's a great revenue earner, isn't it? So I wonder. It'll be interesting to see what the revenues are going to be from this, and whether anyone is actually reacting to it at all, or it just gets baked into the price of everything. But anyway, I mean, just slightly on the note of inflation, I should maybe let Jeremy have the last, I wouldn't say the last laugh, the last word, as I'm aware we're sort of coming to the end of our time around inflation. What does a GST hike do, or because they've split it up, does it just get baked into the background noise of general inflation that is coming our way?
Yeah, it's an interesting question, an interesting thought, I guess. I mean, fundamentally speaking, obviously GST is a consumption-based tax, so it at the end of the day, it is the consumers that will bear the brunt of any GST hike. Even in the case of businesses that aren't able to claim the GST on their costs, generally they're not going to be the ones that will stomach the hike. It is something that they would generally pass on to the consumers within their pricing model. And so it kind of all comes back to additional costs and charges for the consumers on their daily consumption. And I guess there's there's two interesting points to note there. Minister Wong did also announce that they would be launching an anti-profiteering committee, which is obviously designed to mitigate the risk of businesses increasing their prices on the premise that it's due to the GST hike,
right.
even though the prices that they're increasing are probably going to be greater than the 1 or 2%. So they are obviously concerned around the potential behaviour that the GST hike might have driven from some of the small businesses around that. And then I guess again, speaking from the consumer perspective, we will see all the additional costs to the daily cost of living, and I guess that's also one of the fundamental reasons why they have created the budget, the additional GST vouchers in order to defer the actual true cost for the lower and middle income earners, to try and defer that the upfront costs from kicking in, and hopefully begin to kind of to push that further down the road from that perspective. So I guess we'll see what happens in the short term in terms of the rate of inflation, whether that continues to go up, then they obviously may need to reconsider. They may need to reconsider how to get that back under control.
Indeed. So guys, thank you very much for that. I hope everyone has found it enlightening and food for thought. But before we go, of course, we've got our lovely Q&A. And let me take a quick look at the questions down here. We've got them all almost in order of thumbs up. So let's start with a 4, and maybe this is one for you, Engbin. Certificate of residence. When the IRS says no changes to the economic circumstances of the company, what do economic circumstances mean? And what kind of supporting documents are they expecting from taxpayers? In fact, that was so popular, we got another thumbs up while I was reading it.
Okay, right. David, I'll take this question.
Yeah,
okay.
I was throwing
right.
it. We got another one, we got another thumbs up. This is so popular.
Okay, so basically, I think what the revenue want to see is that nothing has changed in as far as the business model of the company. It's still the same way that you actually run the business, whether it's pre-COVID or during COVID, and the same business model that you have used, you continue to use. So now, in terms of what sort of supporting documents, there's a whole host of evidence that you can actually present, because in terms of your whatever you record in your books, if you have always been doing buy-sell, then you continue to show the buy-sell in your books. So that is evidence itself that hasn't been any change in your business. So whatever you basically put through your accounting records, that can be used as evidence, and whatever that you have in terms of your minutes, your in-house management meetings, if you have a change in policy, I suppose you will go through some kind of process internally to do it. Or if you don't have, then basically you can just give them the confirmation that you don't have any change in terms of that business model of your business. Yeah. I
mean, what they're trying to get at is that your seat of power hasn't changed, right? Yep. It's I suppose everyone can change their business model as they like. But if you suddenly, were selling everything in Singapore and now selling it all in Indonesia, and your directors happen to be Indonesian, then there might be different questions asked, or vice versa, actually.
Okay, so okay, I mean, just to add on to what you say, then it's really how you run your business that I'm actually looking at. You know, whether you're actually running your business from Singapore as before, or whether you're running your business outside of Singapore,
Right, yeah.
following, you know, because of COVID or whatever. Yeah, because of the travel restrictions.
But we'll all be traveling again soon, so that
Yep.
should hopefully disappear into the mists of time and be a historical relic. Now then, an anonymous attendee got 5 thumbs up around 14 ZE. The scope of deduction seems to be narrower vis-a-vis the previous subsequent tenancy property concessions. Would you think so? This is probably another one for you.
Yeah, I don't think so. I thought it's been formalized, it's been enacted that you can get the deduction. So the scope of deduction is still the same, the same kind of expenses that you would have incurred like in the past. So in fact, they have also put in another section to say that if your property is vacant, you can continue to claim deductions as well. So they are like trying to make it, you know,
So it is a
more
concession,
general.
isn't it?
No, that previously was a concession. Now
But
it's enacted.
they've enshrined it in the concession in the law.
Yeah. So if you have a vacant property, you can claim some of the expenses that you have incurred on the vacant property. The only thing you need to do is that you must be looking for a tenant. You must put in some effort to look for a tenant to basically fill up the vacant property and not just let it sit there like that.
And not leave it empty. Like
Yes, correct.
Okay. And another anonymous attendee, I wonder if it's the same one. They had a 5. Oh, it will be interesting to see where we are standing vis-a-vis our peers in the region when it comes to METR. That's the minimum effective tax rate. We'll be losing our appeal. Will we be losing our appeal? Although tax is not one of an only concern of potential investors.
So David, can you take this one?
All right, if I must. Yeah, I mean, this comes back, I think, to the question of how much attention our tax incentives are going to get. Obviously, if they get a battering, then it is going to be one of the legs we've stood on for a number of years to attract foreign direct investment. If, on the other hand, we can stand our ground, and there have been discussions with the OECD around specific incentives that they have adjudged not to be harmful tax practices or give rise to harmful tax practices. If we can stay firm on those, then that could go a long way to stabilizing the thing. But it goes back to the point I was making earlier on. If our effective tax rate across the board falls below that 15%, we'll just be basically handing tax revenues to other countries. So we've got to stand firm on our incentives. We've also got, well, I mean, you know my views on this, Engmin, that we should have stood up and been counted a long time ago, but we haven't. We're conceding to what the OECD wants. I don't see, in fact, one of the questions I had for you was whether if the OECD didn't exist, we would be doing this. And the answer clearly is no. We're being told by the OECD that we must do it. If it was good for us, we'd be doing it voluntarily. So I don't think it's great for our appeal, but we have to find a way of living with it without it eroding that appeal.
Yeah, and I think in terms of the incentive, unless, you know, it's carved out, otherwise we will definitely be hit. You know, what's the point of giving a 5% or 0% only for this company to be taxed in their home country? So perhaps we have to look beyond tax incentive to encourage companies to set up here in Singapore.
Yeah, so you would imagine that it's creating a level playing field for everyone in the region. All the people that compete for foreign investment dollars and have their own incentive systems or their own varying tax rates are going to be in the same boat as us. So it comes down to the question of where would you rather be commercially? And I suppose you could say at the end of the day, that's what the OECD are trying to take out of the equation. They're trying to get decisions made for reasons other than tax. So they may end up being successful in that. So let's see if we've got any other ones. We got a couple of twos down here. How likely is the Singapore government implementing capital gains tax in the near future? Adrian, and that's remote. Remember the words near future.
I don't see them doing it in the near future as a blanket capital gains if they were to introduce anything, on the basis that, you know, Singapore has a very strong wealth management industry, and the Singapore government is trying to encourage that along with a fund management industry. And so to implement a general capital gains tax system kind of kicks that a little bit in the teeth. But as I said earlier, we could see capital gains tax introduced in specific areas, vis-a-vis maybe related to second properties, and have a specific targeted approach for the wealthy. But they need to consider it and balance it with, you know, attracting wealth into Singapore. And maybe they look at attracting people into Singapore, not necessarily the wealth into Singapore. So even that capital gains for properties could be just for non-resident landlords rather than people who come to Singapore to live in those properties.
Yeah, and put them to use.
Yeah.
At the end of the day. Okay, and another autonomous attendee or anonymous attendee. David, what is your next prophetic suggestion that will get adopted into budget 2023 or 2024? Capital gains tax on property and an increase in corporate tax. How about that? Yeah, to line up with the pressure that our effective tax rate may be under, and our somewhat dislocated corporate tax rate versus personal tax rates are concerned. There's a guess. If it happens, you heard it here, first of all. And then where have we got? I think, this is a general one. For the purposes of computing the minimum effective tax rate, has there been any guidance on how it is to be computed? Example, would it be based on accounting profit or chargeable income? Well, my understanding is it's based effectively on your accounting profit, which is where you get into all sorts of discrepancies, anomalies, recomputations, administrative work, etc., which is why ultimately I think this is a terrible idea. But yeah, and my understanding, Eng Min, same as you, accounting profit is your effective tax rate, is what we're saying.
Yeah, so it's basically your tax payable based on your tax computation against your accounting profit. So that's your effective tax rate. So because the tax provision that you make is basically what tax you ought to pay, and that is into your accounting books, and then you then divide it by your accounting profits to find out what's your effective tax rate. Yes, I agree with you on that.
Yeah.
You know, as to how it will be calculated.
Yeah, and I suppose one of the things we didn't cover on this was that the minimum tax works in two directions, right? So we could have a Singapore subsidiary of a US headquartered company. Our effective tax rate in Singapore is 10%, so 5% goes to the US, and we never see it. On the other hand, we could be a Singapore headquartered company. We apply METR in Singapore, and it applies to our subsidiaries. And so we have a subsidiary in the Philippines that's only being taxed at 3%. So we get 12% shipped in to Singapore. Now that may sound like a very good idea, but of course what it does is it means that it destroys Singapore's territorial basis of taxation, because as you know, Singapore companies only get taxed when they remit foreign profits into Singapore. And usually these days, because of Section 13(8), don't ask me what it's called now, because it's all been changed, I think, that it's exempt in Singapore. And the reason it's exempt in Singapore is because we didn't want to have to go through all these silly calculations of what was your effective rate in the Philippines? How do we work out the top up, etc., etc. So to me, this is a very much step back into the dark ages, which I thought we'd left when we introduced things. Oh, we got a territorial basis of taxation for a start, but when we introduced things like a foreign sourced income exemption, FSIE, we were trying to achieve simplicity. And where are we heading with this? So I find, which is why I implore the IRAS to make sure that they do take proper advice and input on this from the interested parties, which are taxpayers, tax agents, tax consultants, and everyone else. Probably on that note, and I was going to say it's 5:30 on a Friday, but it's actually only 5:30 on a Monday. It's probably time, I think, to call it to a close. We're just coming up to time. I don't think we'll get to, we can't get to all the questions, unfortunately. So we will leave it at that. If you do have questions, you know where to find us. Please drop us a line. I'd be happy to chat and take things forward. So I think that just leaves me to thank our esteemed panelists and Michelle, our seamlessly hidden MC, for taking care of this afternoon. So I think the last slide explains it all.
Yep. Thanks, David. And thank you to all our panelists for the very, very insightful sharing. And thank you to everybody for attending our webinar today. We would appreciate it if you can actually scan a QR code here to complete the survey and let us know how you feel about this webinar today. Just a note, if you would like to get a certificate of attendance for the CPE hours today, you have to complete the survey and also indicate in the survey whether you would like to receive the certificate or not. Thank you, everybody. If you have any questions, like what David said, you always know where to reach us. Just an email or a call away. Thank you, everyone.
Okay, thank you, guys, everyone.
Thank you.
Bye-bye. Bye-bye.